What's going on, guys? Brian's here. Today is Sunday, June 26, 2022. Jumping right into it, I want to go over a trade recap on Square in which I took recently. Now, it was a swing trade. The reason I'm doing this video is because not too long ago, I did a video on a swing trade in which I took on AMD, and it was a monster win. And I did get a few questions regarding how do you spot these swing trading opportunities, or what do you look for? And it's actually pretty simple. So what we're looking at is the Square on the daily time frame right here. And I just have very basic levels. This is something that every trader should have in their toolkit. It's just drawing out support and resistance levels. So as we can see right here, this is dating back to 2019 right here, and this was a key level right here. Just extended that out, so we have about $82, and let's just say $82 and a quarter. We have this level right here, as you guys can see it on the chart, and then we have this level all the way down here. So just three key levels. At the time when I entered the swing trade, it was actually on this day right about here. But I want to show you guys at least the thought process behind the trade, as well as how you can approach something like this and actually stay in the trade. And this day right here, it caught my attention because I had an alert set at this level from maybe, I don't know when exactly, it could have been months ago, it could have been at the start of the year, but I was notified that Square had hit a key level, and then I immediately pulled it up and started investigating. So that's one of the first things to take note of. Whenever you draw your support and resistance levels, it doesn't mean necessarily you have to hop into the trade. You should then go and further inspect or further investigate to see if you can find any type of confluences. Confluence just means if you can find other reasons that align with your trade idea. So if I'm looking to be long at this level, I want to find other reasons to be long. Now, if we just scroll over here, this is just basic technical analysis or basic price action skills. Previous resistance, as we see right here, once price breaks out, whenever it comes back to the level, that level is more than often likely to hold as it becomes future support. So previous resistance becomes future support, and that's just regular price action. Everybody should know that, and that's what we have on this chart right here. This was just a level at one point, which was resistance during the crash of 2020. As we can see, Square sold off and then it bounced, but it struggled at this level before it broke out, and then it ultimately went on this massive uptrend. But then now this is the first time in which prices come all the way back down to $60. We can see this is the first time it came back to this level right here. This was previous resistance. It broke out right here, price went all the way up, and then this is the first time price came all the way back down to it, and then you guys can see that it ended up bouncing off of that level. So keeping the very basics of just understanding price action, how to read a chart, is just something that's important to know, and that's the first reason why this is on my radar. Next thing, if we were to scroll over to this right here, we know that this is what's referred to as the emotional phases of the market, and we know where the market is currently in. Or if we look at a stock chart like Square right now, and we can see it right here, it looks very similar to this chart, as do a lot of tickers on the market right now. Generally, a market, when it's in a small uptrend right here, it tends to be taking off. It looks like it's going to return back to the mean, and they refer to this as the bear trap. This is when it starts entering its uptrending phase, and then the media starts getting the attention. A lot of retail traders start piling in as everyone becomes very enthusiastic about it. Greed starts kicking in, as this chart is practically going parabolic before it enters in a stage 4 decline right here, and we can see it selling off. And then we're kind of in this phase right here where some tickers are entering the despair phase. Capitulation is a war term. It just means that everyone's surrendering and giving up, and this is when everyone is just saying, get me out of this stock or get me out of this position. So as we look at this chart and we actually zoom out right here, we can see how Square has been trading. It was in right here what would be called we can call this as a stage 1 phase right here. So this is accumulation, and then it enters this markup phase. This is the distribution up here, and then it has this decline phase. So that, what I'm talking about, is what's referred to as the 4 cycles of the market. So we have the accumulation, we have the markup phase, we have distribution, and then we have downtrend. So again, I'll just reiterate that for you guys. If we were to draw it out on the chart, we have, this would be referred to as phase 1, which is the accumulation, and then we have phase 2, which is the markup or the uptrending phase, and then we have up here, which would be the distribution phase, which would be phase 3, and then lastly we would have what would be referred to as a decline right here, or the downtrend. So if we were to put numbers on the chart just to emphasize this, stage 1, stage 2, stage 3 is up here, and then stage 4, and then the cycle tends to repeat itself. So this chart is just kind of showing that, as you can see, the market, or any ticker in which you can use this for anything in which you're evaluating fluctuating, it enters in these different cycles, and things just become a little bit wider and wider as the ranges increase, as volatility increases, or as the stock starts getting larger and larger. So this is kind of where we're at. So the combination of understanding where a square is, understanding where the market overall is, a lot of opportunity to be long, it starts entering this phase here when we're in this despair phase. So I'm combining just classic, price action, technical analysis, reading a chart. This is nothing super fancy here, as well as being patient and waiting for it to come back down to key levels. I was not interested in square anywhere down here because understanding the decline was way too aggressive. There was no need to jump in very early. I was interested in here, but I did not take the trade on square here. So the first step is, if you're looking for these swing trades, the first step is patience first and foremost. This is not on a day trading perspective. As you notice, I'm talking about levels that date back to a couple years ago, and then identifying that there's opportunity here to be long, knowing earnings is coming up. Maybe it's going to have some sort of rally going into earnings, as all of these people that have been shorting from here might start covering. So I'm just layering a little bit of things to pay attention to. Maybe if we were to throw on one study here and we were to put on the RSI, which is the relative strength index, nothing too fancy right here. We can see that it's currently in these oversold levels at this level. So that's something to maybe take note of. But again, you have to take these type of indicators with a grain of salt because nothing is that fancy. These are very popular amongst most retail traders, but it's good to just glance at on a larger time frame just to get some sort of an idea of where things are in relation to each other. Now let's jump down to a smaller time frame and actually see how did things look at this time. So this right here is a 65-minute chart, 65-minute as opposed to the hourly, just because the 65-minute chart is divided evenly into a trading day. So each candlestick represents 65 minutes, and that means we can fit an even 6 candles in one trading day. This right here, the day in which I entered the trade was the 15th, so it would be this day right here. Again, it caught my attention because as it was selling off into this level, this is the same level from the daily time frame. We can see this morning it opened up and it showed a decent amount of strength right here. I really like the volume that came in that morning, so I decided to open up the long trade, thinking that this support was hold, telling myself that I would either have a stop loss below this level or I would give it a certain percent of my position, because understanding stocks like this with the volatility that's occurring is going to take a little bit more room. I am a little bit of a contrarian when I trade, which means I am willing to trade counter trend, but I have key things in which I look for, as well as understanding risk management. So the first and foremost thing is that I'm going to tear into my position, which means if I'm tearing into a position like this, it means I'm going to enter it in about 3 tiers, which means I'll get 1/3 of the size in which I want. I will get 2/3 of the size in which I want. And then lastly, 3/3 of the size I want, which means, let's just say I'm trading options and I want a total of 6 contracts. It means when I first enter the trade on day 1, maybe I'll just get 2 contracts. If it goes a little bit lower, I will get 2 contracts, and then once I get confirmation of the trade working, I will get the remaining 2 contracts, which means I enter in a total of 6 contracts, and then I will scale out as I start getting my profit target. In this case, the target I was looking for was 60 all the way up to 65, with a potential runner all the way up to 82, because this down here is support, and if we're just trading buying on support, we look to sell at resistance. It's very simple, guys. I mean, the more and more you get into trading, the more and more you tend to complicate things and make it very difficult for yourself. But if you keep it simple, the basics that you learn when you first start trading is support and resistance, and those should be things that you really keep in mind. It doesn't need to be that complicated. You can start layering other patterns on your chart and telling yourself, to make it a little bit fancy of other things that might happen, but at the core, you just keep it simple. This is essentially support, and this is going to be resistance, so it's probably going to be buyers down here, and there are probably going to be sellers up here. As you can see right now, if we zoom in, we can see a lot of the volume started coming in as we started dipping below the support. There's going to be a lot of liquidity just in areas where a lot of retail traders are stopping out. So in the case, this is one mistake in which I made. Now I'll explain why. I took my stop loss. I was very heavy long to the downside and a lot of other tickers last week, so I just needed to reduce a little bit of my risk personally. As we scroll over to the Discord right here, I can show you guys this is exactly when I first mentioned the trade. So I believe it was right here. So I'm just getting a starter on June 15th, just getting a starter position in QQQ with 16 days till expiration, diagonal call spread. This is right before the FOMC, so and Square was in a major downtrend, so it wasn't a position in which you want to get aggressive with. This was the FOMC right here, so there's a big economic event that's happening at 2 p.m. Eastern time. So the smart thing to do is wait until after the event comes out before putting too much risk on a trade and then getting overly aggressive, and then the market just drops going into, depending on what the Fed says, what Fed Chairman Powell was to say, because everyone wanted to know if they were going to raise interest rates by 75 basis points or if it was going to be 50 or possibly even 100 basis points. So you generally just want to wait and to find out until the report comes out before you make your next big, swing trade position. However, I couldn't deny the opportunity that was in front of me, so I did want to get my position prematurely. Now, I'm comfortable doing this again because I know how to manage my risk. The reason I open what's called a diagonal call spread is because it allows me to manage my risk accordingly and yet still exploit the phenomenon known as options convexity, which means I'm actually not risking that much to the downside relative to how much I can make if I end up being right. We'll get into exactly the trade in which I took in a second, but I just want to first go over the price action, things to look for. We can see the volume coming into this day. So my reasons for getting into the trade started from the larger time frame, the daily. We dialed it into a 65-minute chart. We don't necessarily need to drill it all the way down to a really, really small time frame, but this would be the 15-minute chart. We can see how Square opened up really aggressively. So I waited about an hour and a half, let it pull back into this level, and then I decided to get long right here. Now, as we look forward in the chart, you guys can see this is a little bit unexpected, but we'll get into that in a second. So as we scroll over here, the next thing you're going to want to do if you're looking to open up some sort of a swing trade is you really want to get familiar with the ticker in which you trade. And by getting familiar, that means maybe knowing or getting acquainted with some of the statistics behind the stock. So in this case, again, Square has been in a very severe downtrend this year right now. So 58% of the time, it's closing red on the daily time frame. And this is accounting for the last 365 trading days or 250 trading days or the last 365 days of the year. This is just a chart showing the average net changes. And this is one standard deviation of all of its moves. So it's just saying on average, Square is going to close about 4.85% either up or down. This is just saying for the past 365 days, it's actually been down 71%. By the way, this statistics is just straight from the Quant Trading app website. I am the lead developer on Quant Trading app, but I'm showing you guys right now how you can use this type of information for when you're building out a trade idea. We can see right now, this is a representation of all the daily closes right here. And if we were to just split this chart, you guys can see there's so much more red and there's so much more big red days that are closing outside of its one standard deviation relative to the green days on this side. It's much more sparse, much more scarce. So that's one thing to just take a note of. Again, it's not necessarily an ideal candidate for a stock in which you're going to want to be long, but again, I'm comfortable trading these types of tickers because I have a key list of things in which I look for. As we look right here, the thing to take away is the average body range as well as the average net change. So we can just average these two out and just say about 5 points. That's going to create some sort of a realistic expectation for myself for when I'm coming up with my profit target, because if Square is at 60 and I think it's going to want to go up to 70, I need to have it as some sort of realistic expectations. It means it's not that far-fetched to believe that Square can hit 65 within a day or two, and then within another couple of days it could potentially hit 70 if it was to get into some sort of momentum into an uptrend. So first and foremost, you really want to become acquainted with what you're trading. So you can use, I believe Yahoo Finance has a way for you to at least download an Excel spreadsheet to get an idea of, on average, how much does a ticker move. On top of that, if we were to just switch this over here, I'm going to want to get some sort of an idea of a time frame, maybe on the weekly basis. Okay, so it's doing about 10 points around right here on its average body range. On its average body range, its average actual range is about 21 points. So that's well within the expectations for what it can do. Me having a profit target from 60 all the way up to 70 is 10 points. So it's very realistic for Square to do that. Now, I am predominantly an options trader, so I'm going to show you guys the spread in which I use to take the trade, which is what was listed right here. It's a diagonal call spread. I love trading spreads, guys. And if you are not used to trading spreads, or you're new to trading spreads and you're within your first year of trading options, I highly encourage you guys to get acquainted with spreads. It's something that I wish I was taught when I first started trading options. I first traded equity for a couple of years before I actually touched options, because everything in which I read when I first started, all the books in which I read, they mentioned that options trading as an option buyer was necessary. It's more so a losing game. It benefits an option seller. And then knowing that the odds were stacked against me if I was going to be an options buyer, I wanted to really get acquainted with the stock market before I started trading options. It seems a lot of newer traders right now are jumping into the market and immediately jumping into trading naked options. And naked option is just when you just buy a call because you think a stock is going to go up. So what I'm going to do right here is actually, let's take a look at the P&L curve for the same trade. And I marked this off on this chart right here. So this is exactly the $70 call that expires this upcoming Friday. So this is a call at the time which would have still had 2 weeks until expiration. And if we take a look right here, this was the day in which the trade was entered. So this was June 15th. You guys can see just 2 days later, this call was completely crushed, being down 77%, and which is down $190 per contract. So the contract was initially going for $245. The risks inherently, if you're trying to trade, or if you're trying to swing trade and you find yourself always losing money swing trading and you're trading naked options, it's because the odds are seriously stacked against you. If you know anything about time decay, that will hurt you, as well as understanding that if the trade is going against you, you're going to be losing on time decay. You're going to be losing if implied volatility is coming down, and then you're also going to be losing if your delta is positive because you bought the call in and the stock is also going down. So you're losing money on because you chose the wrong direction, because time is passing by, and then also because implied volatility could be coming down. So there's a lot of things stacked against you, and it's very hard to hold this because assuming you enter in, we'll say 4 of these contracts, that's about $1,000 of your capital. And then 2 days later, you're down over $750. There's no way you're going to continue to hold this. And then you're talking about even if you decide to hold it for another day and then the stock bounces just a little bit, then the next day it comes right back down, you're down $700 again. Psychologically, what most people will do in this case is close the trade out anywhere within these couple days. And you're not wrong for closing this trade out here, because the likelihood of the trade working in your favor is very low. As we can see, it finally went to your break even on this Friday after buying it from the previous previous Wednesday. That's a lot of trading days to be in a position to be in the red for 1, 2, 3, 4, 5 trading days, only on the 5th day for it to become break even. And more than likely what most people do is you just close it once you hit your break even. But let's just say you did hold, you finally get your reward of say 47%, or you're still holding. If Square was to just slightly gap down tomorrow, let's just say it was just down maybe 1 or 2 points, this call would probably be back in the red, and then you're definitely closing it out right here, because why take the risk of it, holding it for all the way back down here. On top of that, now this contract expires this week because it only has 5 days till expiration. So now you're dealing with a weekly contract, so the risk is even inherently higher. What I decided to do was swing, again, what was called a diagonal call spread. So if we pull this up right here, all it means is I thought Square was going to 70. So what I do is I buy the $70 call, or you can buy the $70 call, and this is how you structure a diagonal call spread. This is exactly when I opened the trade right here. So it was on June 15th as I shared it within the Quant Trading app Discord, and that's what you guys are seeing right here. This is straight from at the timestamp in which it was in which I first opened the trade. I started off by just getting 2 of these. So in terms of the position size, it's nothing too crazy because I'm just looking to get started. Usually a trade like this, I would want to scale into about 6 and keep it to about this position size and risk about 50%, because essentially it should have high probability of success if I end up being right. But let's just scale it down and not really to be too concerned with exactly, how many contracts I'm getting or so. I just want to show you guys for $256, let's just say you grab 2 of these, that's around $500. That means if you take a 50% loss, you're taking about a $270 loss or so. That's not that bad in the grand scheme of things, considering how many odds are working in your favor on a trade like this. The reason I like something like this is because when you open it, you actually don't have a negative theta, which means you're not in a rush for the trade to work out right away. You have plenty of time. You have, in this case, it would have had 16 days till expiration, 17 days till expiration, or at least 2 weeks. And even if Square was just hovering right around 60, you actually would not have been losing that much money. And then even if once Square went up to about 66, it increased the break even on the trade. That's something that I really like doing. And on the previous video on AMD, I went a little bit more into detail on the spread itself, but that video was a lot longer, and I'm trying to keep this video not as long. So I'm not going to explain how the spread works. All it means is I'm buying a call that's further out right here, so 4 weeks till expiration, and then I'm selling a call or shorting it another call that expires closer to expiration, what ends up happening is you're collecting a credit from selling this one. So collecting 100 in this case, again, these prices are would be different. Now this is not exactly this right here. This screenshot is, or this page on option strat, and which is what I'm showing you guys this right here. This is actually how much the trade had cost me at the time with 2, but let's just decrease this and bring it back down to 1. But the price of these contracts, I don't remember exactly. You don't really pay attention to how much the individual legs of the contract are going for when you open the spread. You're just concerned with exactly how much it costs. It means this spread costs $2.61. Now I received $130 in credit, and that's reducing the cost of this $70 call right here. So if this call is going for $4, and then I'm getting a credit of $1.33 from the other spread, then it reduces the cost of $4 down to this much. So again, that's just a little bit of how this works. But if you're unsure, I would highly recommend you just look up diagonal call spreads and get familiar with reading a risk profile, so you can get familiar with these types of spreads. But by buying the $70 call, it means I'm lowering the break even. So if Square is at $60 in the time in which I'm looking to open the trade, or $61 or however it was, now I've reduced the break even, because if you buy a naked call, you actually need the price to go much higher than what you're targeting. So in this case, this is the $70 call. Because this call would cost about $4, the break even is, if I think Square is going to go to 70, you actually need it to go higher than 70 if you're looking to actually hold it until the week of expiration to make any kind of money. Because the only way you actually make money by the day of expiration is if the call or the contract is actually in the money. So you're asking from Square all the way down here from 60, you actually need it to go all the way up to practically 74. So you're asking for 14 points, which is asking for a lot, to be profitable. But if we were to just turn this into a spread, and then we include this right here, now we're asking Square to go from 60 all the way up to 65. We're only asking for a 6-point increase. Imagine if you're playing a game, and in order to win, you need 14 points to win the game versus 6 points. Where do you have better odds of actually winning? Which situation? Asking for a less amount of points increases your odds to actually win the game. So in this case, if you want to think of trading, or you want to use the point system as a way to determine your probability of success, you're inherently increasing that, and then you're also decreasing your risks. And then on top of that, you're decreasing one of the biggest components of what kills a lot of options positions, is the negative theta. But by opening a spread like this, you have positive theta. Let's take a look at the P&L curve right here. So this is the P&L curve for the spread. It was open on the 15th, but let's jump over to Thinkorswim. And within Thinkorswim, we can actually see the P&L curve, or the actual closing price and opening price of each of 15 minutes for the spread. This was the day, again, June 15th, in which the contract was open, or the spread was open for $2.61. We can see a couple days later, I'm using the exact low. So obviously this only just touched down here, but we're going to use that as a baseline for how bad would it have been. The actual pain would have been more so around here for $1.60. So only down about $100 per spread. But we're going to be fair to compare this to the naked option. I want to use the extreme worst case scenario. In this case, it's down 55% in terms of the timeline of when this position was open. This was the exact maximum pain right here. So down 55%, meaning down $142. So the difference between assuming, when we said you bought the naked option, being down over $750 if you put 1K into the trade, here you're only down about $550. And then by Friday's close, the spread was actually well into the green from the Thursday, and then by the Friday you were definitely well into the green, being up 70% at this point, versus the naked option is only up 47% with very low odds right now that it's a weekly option, which is $115. But this trade costs $2.45 compared to the spread in which I'm showing right here costs $2.61. So they almost cost about the same, but this spread is actually up more than the naked option, and it actually wasn't red or significantly red, deep into the red for days. So it's a lot easier of a psychological hold. Now the call diagonal spread in which I entered was a little bit aggressive, because I was expecting Square to make a move very aggressive very quickly, because I was expecting a huge bounce in the market. I did not expect this breakdown here. So I actually did take my stop loss, because I was actually down that 50% there, and I never scaled into my my second tier. Generally, the reason for me is because I was long a lot of contracts here. If I just jump into this right here, I went pretty heavy last week, and around that same time here if I was to I was in a call diagonal spread on the SPY, so which I closed out for about 42%. This week here on Friday, and then I was also, and we scroll down here, I was in a call diagonal spread on the Qs, and I was in multiple of all of these here, and this is the IWM, so the Russell. So I was in call diagonal spreads across the board. So even though I close out squares, just because I don't like having so many open positions that are all in the same direction, I just rather put some more risk onto the Qs because I had fairly high reasons to believe the market was going to bounce. So instead of choosing an individual tech stock or an individual tickers or a handful of individual tickers, I rather just put more capital into the ETFs, which should be the NASDAQ, the SPY, and the Russell. I just felt more comfortable. So that was my main reason for reducing my risk. Now, another reason why this trade caught my attention was because the implied volatility was pretty high on the shorter term contracts right here. This was the one in which was being short, so the July 1st, which is this upcoming Friday, and then being long the July 15th. So these are the contracts that have less IV. Whenever you're running any type of diagonal spread or a calendar spread or anything like that uses two different expirations, you generally want to short the expiration that has high implied volatility, except for if it's the week of earnings or something like that, because the IV will continue to increase drastically for this contract. So that's something to stay away from. But for the most part, you're trying to take advantage of the skew right here. It means I'm shorting contracts, collecting more premium than what it cost me to buy the longer dated contracts, which have a greater chance of actually working. And we can see right here, the implied expected move by this week was about 11 points from the time in which I opened it. So I was right in alignment with the 10-point expectation in which I was expecting with Square. Now, as we continue right along right here, this is just showing a little bit of Confluence. The quant trading app members are aware of this. We have a script that generates certain levels on our charts. So this is the other reason Square was in, it had my attention. It's because of the fact that it was in what was referred to as the quant trading app buy zone. So we had the Confluence of the $60 level. It was in the buy zone. So I was just letting everybody know, I think it can go up to about 75. 70 was the for sure safe target, but then showing everyone the same thing, which I'm showing you guys now. Here was it hitting that level. And then we have the open interest levels. So within quant trading app itself, if we were to come right here, we can create a custom script, which is actually going to take all of the open interest for any tickers in which we like. We can type down more down here, but all I have to do is just press this create study button. It'll actually generate a TOS study in which we can take right here. If I were to click this, just bring this onto my charts. Let's go back to the daily. Let's actually hide all of this so it's nice and clear. And then let's go to studies and type in, I'm just going to QTA month. Just going to type in monthly right here, double click this right here. And let's just make sure I'm copying and pasting this brand new code. I just press OK, and then I have, these are all the high open interest levels for the monthly expiration. And then at that time, they was showing that there wasn't much of a resistance between the level in which we see right here was on the $60 level, which was support. 70 was another high open interest level, and then they had room all the way up to 85. So the potential highest level I would be expecting was 85. So that's all that's just showing. So just showing a few different confluences right here, very subtly. Lastly, I went and looked at the just flow. So I take this again with a grain of salt, just coming to get an idea. So this was the historical flow. So this is what I checked from the past 2 weeks. So from the end of the previous month right here, which was May, all the way up until the 15th, which was the day of, I did a search. I just tried to increase the minimum premium, so to filter out the results so it isn't too much, just to kind of show, because out here this high is too low of orders. So just pulled it down to about 100 grand, and then I just made sure to check off right here only the out the money option. So if I would out the money spread, so if I turn this on right here, this is showing the out the monies, and just to get a general feel. So it's sort of like they were selling the $60 put, the 77.5 call was being opened, decent amount of premium, and just scrolling just to make sure there's nothing too crazy. Again, this is just to get some sort of an idea. This is showing that overall it's about split and neutral according to option strat, but I saw that there was a decent amount of put selling, and on top of that, it was nothing too alarming. Not that this would have stopped me from taking the trade, but it was just to get an extra data point to feel a little bit more confident in the trade. And then lastly, I just want to show another alternatives. If you've seen any of my previous videos, you guys know I love the calendar spreads for new people that are now trying to start trading spreads. So in a sense, Square was all the way down at 60. If you think it's going up to 70, instead of trading the diagonal, which is what I traded right here. I bought the $70 call and I shorted the 75. You can actually just do the same strike across both expirations, and this is actually a safer, cheaper trade to take. So I had higher conviction, so I went with something a little bit more aggressive. But this right here is what's referred to as a call calendar. You're pretty much just buying a contract that you think it's going to go to for a further dated contract, and then you're shorting the same strike on a shorter term contract, and it creates this profile right here called often referred to as a tent. So as we go back to the chart and we actually look at the P&L curve for the $70 call calendar, you guys can see how safe this one looked. So this spread would have been going for $1.14, and at the max drawdown a couple days later, it was only down $55 per contract or per lot, which is only down about 40%. And then by Friday, it actually ended up being up almost 68% here, or about $100. So this, I mean, at one point it was up a little bit more than $100, but I'm using the closing price on Friday. So you guys can see that this is a really, really safe way to actually swing a trade, which means you're not taking on much. You're limiting your downside risk pretty tight. And this we're talking about as we look at the chart again, and we come and we look at this right here. From the time the spread was opened, if we were to use this as the drawdown, Square was actually down about 10%, which is horrible. And now it's actually up about 13%. So even though Square has not gone up that much relative to how much it was down, from a traditional risk reward standpoint, if you're risking, you know, this much, which is let's just say you're risking 10 points and you're looking for about this much, you're essentially risking, this is 1, this would be a 2, and this would be a 3. You're essentially risking 1 to make 2. This is a 2-to-1 risk reward, as this is referred to. If we're looking at it from that standpoint, this is actually not that good of a trade from a risk reward standpoint. Anyone just buying in this area, to make the risk reward worth it, you would almost need to be targeting all the way up here to get a 3-to-1. And that's traditionally how trading is taught. You want to look for a 3-to-1 risk reward ratio and things like that. But if you understand options and you understand how to take advantage of options convexity and putting other things in your favor, such as theta, and letting time passing by, you can actually open yourself up to a much higher risk reward, because now we're talking about the reward right now is up almost 70%, and this trade still has a few more days to go. And the more and more time that passes by, this spread will actually hit a max profit of somewhere around, you know, 200 and change, $300. Again, this is from the time, if this was opened right now, so I don't have a screenshot because I didn't open the call calendar, so I can't show it from when I actually opened it, unless I were to go in here and actually adjust the price, and I'd have to look up what it was going for. This was actually saved under my one of my saved trades, so that's why I can show you guys the timestamp in which it was actually opened and the exact price in which it was going for at the time. But again, with this calendar now, as Square just kind of hovers in this area as it should, the P&L would start increasing as more time passes by right here. So the more time passes by, the closer and closer it gets to expiration, you'd actually hit your max profit. But you don't hold these types of spreads for max profit. But I'm showing you guys this is much nicer. So if to recap, we just look at the 3 examples. Here would be the naked option. Very difficult to hold. Look at how horrible this feels being down. You just feel like you're just completely wrong. You're going to tell yourself there's no way you can make any type of money in this trade. So you close it, you take a big loss, you take a few losses like this. Let's just say you have a 5K account and you don't understand position sizing or risk management, and you put 1K in a trade like this because you want to make $5,000 in 2 days, and then you take a $700 loss like 2 days later. That demoralizes you. Your account takes a big hit. Now you're down to $4,300, and then you do something else similar, and then you take, say for example, then $1,000 hitter. So it's very easy to blow your account if you're trading options. But if you can take a step back and say like, okay, I'm going to run maybe some sort of spread like this given a little bit of time, and for $1.40, you know, you can come with a plan and say like, okay, if I was down 40%, I'm going to be down about $55. I want to use $200 in risk. That means you can get about 4 of these contracts. 4 of these contracts, you're using, I don't know, about $600, just under $600 in capital, and you're only risking $200. So now you're risking $200 out of a $600 position size. And if you're right, you're looking to make about $100. So out of the 4 lots in which you would have purchased, that's $400 reward. So now you're risking $200 to make $400. However, you have much higher odds of this actually happening. So it's all about the probability of success and your risk reward. It's not just about risk reward. And then this contract still stands to gain a lot more depending on as time goes by. So hopefully, again, I'm just trying to shed more light on swing trading, how I approach the market. I'm just looking for about 3 to 5 solid trades a week that are swing trades, in addition to a lot of my non-directional trades and things like if I were to scroll down to most recently as the market closed, stuff like this where it doesn't really matter which direction the market goes. I'm just looking to capitalize on a little bit of time decay and theta with an at the money iron fly, as well as iron condors and things like this. So this would be an iron condor right here. Also for this week, this is a very short-term iron condor, which is a lot riskier than I normally would run, but not going to get into that. That's for other videos. But just trying to explain to you guys, you can swing trade in this market environment if you know what to look for, if you're patient, if you know how to structure your spreads, and just wait. You can consistently get about 10 solid trades a month. And even if your win rate is 70%, or even with a 60% win rate, if you're pulling in about $400-$500 per trade, even with a $5,000 account, and you keep your losses to under $250, even under $300, you can still be profitable at the end of the month and take a $5,000 account and make about $1,500 at the end of the month. And then now you have an account that's grown. And then the second month you can make $1,800 or so just from swing trading. I'm talking about just taking about 10-15 trades tops a month and just being patient. So hopefully this will shed some light, and thanks for watching. I'll catch you guys in the next one.